Section 1.1 to 2.1 Asset Classes, Introduction to Asset Classes. 1.1 What is an asset class? Asset classes refer to broad categories or groups of financial instruments or investments that share similar characteristics, behaviors, and risk-return profiles. Each asset class represents a distinct type of investment with its own unique set of features, market dynamics, and performance drivers. Here are some commonly recognized asset classes: equities, stocks, ownership shares in publicly traded companies; fixed income, bonds, debt instruments issued by governments, municipalities, or corporations, which pay periodic interest and return the principal amount upon maturity; cash and cash equivalents, highly liquid and low-risk investments, such as bank accounts, money market funds, and short-term treasury bills; real estate, properties, including residential, commercial, or industrial, that generate income through rentals or appreciation in value; commodities, physical goods or raw materials like gold, oil, agricultural products, or industrial metals, often traded on exchanges; alternative investments, diverse range of non-traditional investments, including hedge funds, private equity, venture capital, real assets, example, infrastructure, natural resources, and derivatives. The importance of asset classes lies in their role in constructing investment portfolios that align with an individual's financial goals, risk tolerance, and time horizon. Here's why asset classes are significant. Diversification. Asset classes tend to behave differently under various market conditions. By diversifying across asset classes, investors can potentially reduce the overall risk of their portfolios. When one asset class performs poorly, another may perform well, mitigating losses and smoothing overall returns. Risk management. Different asset classes exhibit varying levels of risk. Some asset classes, such as equities, tend to have higher volatility, while fixed income investments offer more stability. By allocating investments across different asset classes, investors can manage risk according to their risk appetite and investment objectives. Return potential. Asset classes also vary in their long-term return expectations. Historically, equities have offered higher returns over the long run compared to fixed income investments or cash. However, past performance does not guarantee future results, and different asset classes may have different return potential based on prevailing economic conditions. Asset allocation. Asset classes provide the building blocks for constructing an investment portfolio. Asset allocation, the process of distributing investments across different asset classes, is a crucial determinant of a portfolio's risk-return profile. Strategic asset allocation aims to achieve an optimal mix of asset classes to maximize returns within an investor's risk tolerance. Market exposure. Asset classes offer exposure to different segments of the economy and financial markets. By investing in various asset classes, investors can participate in the growth and development of different industries, sectors, and geographic regions, thereby gaining broader market exposure. It's important to note that the performance and characteristics of asset classes can vary over time, influenced by factors such as economic conditions, geopolitical events, and market sentiment. Therefore, investors should regularly assess their investment strategies and adjust their asset allocation as needed to align with their evolving financial objectives and market conditions. Asset classes play a vital role in portfolio construction. They serve as the building blocks for designing investment portfolios that align with an investor's financial goals, risk tolerance, and time horizon. Here are the key roles that asset classes play in portfolio construction. Diversification. Asset classes exhibit different risk-return characteristics and tend to perform differently under various market conditions. By diversifying across asset classes, investors can potentially reduce the overall risk of their portfolios. When one asset class performs poorly, another may perform well, mitigating losses and smoothing overall returns. Diversification helps to spread risk and enhance the resilience of the portfolio. Risk management. Each asset class carries its own level of risk. Some asset classes, such as equities, have higher volatility and risk compared to fixed income investments or cash. By allocating investments across different asset classes, investors can manage risk according to their risk appetite and investment objectives. Balancing higher risk assets with more stable assets can help control the overall risk exposure of the portfolio. Return potential. different asset classes have varying long-term return expectations. Historically, equities have offered higher returns over the long run compared to fixed income investments or cash. However, past performance does not guarantee future results, and different asset classes may have different return potential based on prevailing economic conditions. By including a mix of asset classes in a portfolio, investors can aim to achieve an optimal balance between return potential and risk. Asset allocation. Asset allocation refers to the process of distributing investments across different asset classes. It is a crucial determinant of a portfolio's risk-return profile. The strategic asset allocation aims to achieve an optimal mix of asset classes based on an investor's financial goals, risk tolerance, and investment time horizon. By strategically allocating investments, investors can balance their return objectives with risk management. Rebalancing. Asset classes can have different performance patterns over time, leading to a deviation from the desired asset allocation. Rebalancing involves periodically adjusting the portfolio's asset allocation back to the target weights. This ensures that the portfolio remains aligned with the investor's goals and maintains the intended risk-reward trade-off. Rebalancing allows investors to take advantage of asset classes that have performed well and trim those that have become overweight. Market exposure. Asset classes offer exposure to different segments of the economy and financial markets. By investing in various asset classes, investors can participate in the growth and development of different industries, sectors, and geographic regions, thereby gaining broader market exposure. This exposure provides opportunities for capital appreciation and diversification benefits. It's important for investors to carefully consider their financial objectives, risk tolerance, and time horizon when constructing a portfolio using different asset classes. Regular monitoring and periodic adjustments to the asset allocation may be necessary to ensure that the portfolio remains aligned with the investor's goals and reflects changing market conditions. Here's an overview of the major asset classes: stocks, bonds, cash, and alternative investments. Stocks, equities. Stocks represent ownership shares in publicly traded companies. When you buy a stock, you become a partial owner of the company, and your returns are based on the company's performance. Stocks offer potential for capital appreciation and dividends. However, they also carry higher volatility and risk compared to other asset classes. Stocks are typically suitable for long-term investors seeking growth and willing to tolerate market fluctuations. Bonds, fixed income. Bonds are debt instruments issued by governments, municipalities, or corporations. When you invest in bonds, you are essentially lending money to the issuer in exchange for regular interest payments and the return of the principal amount upon maturity. Bonds are generally considered lower-risk investments compared to stocks, providing more stability and predictable income. They are suitable for income-oriented investors and those looking to preserve capital. Cash and cash equivalents. Cash and cash equivalents include highly liquid and low-risk investments such as bank accounts, money market funds, and short-term treasury bills. Cash investments offer the highest level of liquidity and are considered the least risky asset class. They provide stability and easy access to funds but generally offer lower returns compared to stocks or bonds. Cash is suitable for short-term needs, emergency funds, and preserving capital with minimal risk. Alternative investments. Alternative investments encompass a diverse range of non-traditional assets that fall outside of stocks, bonds, and cash. This category includes hedge funds, private equity, venture capital, real assets, e.g., infrastructure, natural resources, and derivatives. Alternative investments often have unique risk-return profiles and may offer opportunities for diversification and potentially higher returns. However, they can also involve higher complexity, illiquidity, and higher investment minimums. Alternative investments are typically suitable for sophisticated investors with longer investment horizons and higher risk tolerance. It's worth noting that within each asset class, there are further subcategories and investment options with different risk levels, return expectations, and characteristics. Investors often combine multiple asset classes within their portfolios to achieve diversification, manage risk, and pursue their financial goals. The specific allocation to each asset class depends on individual circumstances, investment objectives, and risk preferences. It's advisable to seek guidance from a financial advisor when constructing an investment portfolio to ensure it aligns with your unique needs and goals. 1.2 Risk and return relationship. Understanding the dynamics between risk and return is essential for investors and plays a crucial role in making informed investment decisions. Here's an overview of risk and return dynamics. Risk refers to the uncertainty or potential for loss associated with an investment. It represents the possibility that the actual outcome or return of an investment may differ from the expected or desired outcome. Different investments carry different levels of risk. Some key aspects of risk include market risk, the risk that an investment's value will fluctuate due to broader market conditions, such as economic factors, geopolitical events, or changes in investor sentiment. Credit risk, the risk that a borrower or issuer of debt, such as a company or government, may default on their payment obligations, resulting in a loss of income or principal for the investor. Liquidity risk, the risk that an investment cannot be easily bought or sold without significantly impacting its price. Illiquid investments may be difficult to convert into cash quickly. Inflation risk, the risk that the purchasing power of the investment's returns may be eroded over time due to inflation. Reducing the real value of the investment. Concentration risk, the risk of holding a large portion of investments in a single asset, sector, or geographic region. If that asset or market underperforms, the entire portfolio may be affected. Return refers to the gain or loss on an investment over a specific period, typically expressed as a percentage. It represents the financial reward or profit generated by an investment. Different investments offer different levels of potential return. Key aspects of return include capital appreciation, the increase in the value of an investment over time. This can occur in various asset classes, such as stocks, real estate, or commodities. As a result of market demand, company performance, or other factors, dividends or interest payments, the income generated by certain investments, such as stocks that pay dividends or bonds that pay interest. These payments contribute to the overall return of the investment. Risk-return trade-off, the relationship between risk and return is generally characterized by a trade-off. Investments with higher potential returns tend to carry higher levels of risk, while investments with lower risk generally offer lower potential returns. This trade-off implies that investors seeking higher returns must be willing to accept a higher level of risk. The optimal balance between risk and return depends on various factors, including an investor's financial goals, time horizon, risk tolerance, and investment preferences. Some investors may be more comfortable with higher risk in pursuit of potentially higher returns, while others may prioritize capital preservation and opt for lower-risk investments with more modest returns. Diversification and risk management. Diversification is a strategy that helps manage risk by spreading investments across different asset classes, sectors, and geographic regions. By diversifying a portfolio, investors aim to reduce the impact of any single investment's poor performance on the overall portfolio. Diversification can provide potential benefits in terms of risk reduction without sacrificing returns. It's important to note that risk and return are not fixed or guaranteed. They can vary based on market conditions, economic factors, and other variables. Historical performance can provide insights, but it does not guarantee future results. Therefore, it's crucial for investors to conduct thorough research, assess their risk tolerance, and seek professional advice to align their investment choices with their financial goals and risk appetite. Risk tolerance and investment objectives are key factors that shape an investor's investment strategy and asset allocation decisions. Let's explore what each of these terms means. Risk tolerance. Risk tolerance refers to an investor's ability to endure fluctuations in the value of their investments and tolerate the potential for loss. It reflects an individual's comfort level with taking on investment risks. Risk tolerance is influenced by various factors, including financial situation. Investors with stable income, substantial savings, and fewer financial obligations may have a higher risk tolerance compared to those with limited resources or financial responsibilities. Time horizon. Investors with a longer time horizon, such as those planning for retirement many years in the future, may be more willing to take on higher levels of risk since they have more time to recover from potential losses. Knowledge and experience. investors with a good understanding of financial markets and investment principles may be more comfortable with taking on higher levels of risk. Emotional and psychological factors. Each individual has their own emotional response to risk. Some investors may be more prone to anxiety or stress related to market volatility, while others may have a higher tolerance for risk and be less affected by short-term fluctuations. It's important to assess and understand your risk tolerance before making investment decisions. A mismatch between an investor's risk tolerance and the actual risk exposure in their portfolio can lead to emotional stress, poor decision-making, and potential financial losses. Investment objectives. Investment objectives are the financial goals that an investor aims to achieve through their investment portfolio. Objectives can vary widely depending on individual circumstances and may include capital preservation. The primary goal is to protect the initial investment and maintain its value. Investors with a low risk tolerance may prioritize capital preservation over seeking high returns. Income generation. The objective is to generate a steady stream of income from investments. This goal is common among retirees or individuals seeking regular cash flow from their investments. Growth or capital appreciation. The aim is to achieve long-term growth by focusing on investments with higher potential for capital appreciation. Investors with a longer time horizon and higher risk tolerance may prioritize this objective to accumulate wealth over time. Risk-adjusted returns. The objective is to achieve a balance between risk and return, aiming for consistent returns while managing risk. This approach considers both the potential for growth and the need to protect against significant losses. It's important to clearly define your investment objectives as they guide the selection of appropriate investment strategies and asset classes. Your investment objectives should be specific, measurable, achievable, realistic, and time-bound. SMART goals. The alignment between an investor's risk tolerance and investment objectives is crucial. Higher risk investments may be suitable for investors with higher risk tolerance and growth-oriented objectives, while lower risk investments may be more suitable for those with lower risk tolerance and capital preservation or income generation objectives. Consulting with a financial advisor can be helpful in assessing risk tolerance, defining investment objectives, and designing an investment strategy that aligns with your goals and risk profile. Balancing risk and return across asset classes is a fundamental aspect of constructing a well-diversified investment portfolio. Here are some key considerations for achieving this balance. Understand the risk-return profiles of asset classes. Different asset classes have varying levels of risk and return potential. Stocks, for example, generally offer higher potential returns but also come with higher volatility and risk compared to bonds or cash. Bonds tend to provide more stable income but may have lower potential returns. Understanding the risk-return characteristics of each asset class is crucial for effectively balancing them in a portfolio. Determine your risk tolerance and investment objectives. Assess your risk tolerance and investment objectives to establish guidelines for your portfolio's risk-return balance. If you have a higher risk tolerance and are seeking long-term growth, you may allocate a larger portion of your portfolio to stocks. Conversely, if you have a lower risk tolerance and prioritize capital preservation or income generation, you may have a higher allocation to bonds or cash. Diversify across asset classes. Diversification is a key strategy for balancing risk across asset classes. By spreading investments across multiple asset classes, you can potentially reduce the impact of poor performance in any single asset class on your overall portfolio. Diversification helps mitigate concentration risk and provides exposure to different sources of returns. Consider including a mix of stocks, bonds, cash, and potentially alternative investments to achieve diversification. Consider correlations. Correlations represent the relationship between the performance of different asset classes. Understanding the correlations between asset classes is crucial for effective portfolio diversification. Ideally, you want to include asset classes with low or negative correlations, as they tend to move independently of each other. This helps to reduce the overall volatility and risk of the portfolio. Periodically rebalance. Asset allocation can drift over time due to varying performance among asset classes. To maintain the desired risk-return balance, it's important to periodically review and rebalance your portfolio. Rebalancing involves adjusting the allocation of assets back to the target weights. This ensures that you're not overly exposed to asset classes that have performed well recently and helps you take advantage of opportunities in underperforming asset classes. Seek professional guidance. Constructing a well-balanced portfolio across asset classes can be complex. Consider seeking advice from a financial advisor or investment professional who can assess your risk tolerance, investment objectives, and time horizon to provide personalized recommendations. They can help design a portfolio that aligns with your goals, risk profile, and market conditions. Remember that balancing risk and return is a dynamic process. It requires regular monitoring, evaluation of changing market conditions, and adjustments to the portfolio as necessary. Regularly reviewing your portfolio's performance and consulting with professionals can help ensure that the risk-return balance remains appropriate for your financial goals and risk tolerance. Section 2. Traditional Asset Classes. 2.1 Stocks, Equities. Stocks and equity investments represent ownership shares in companies. Here are some key characteristics of stocks and equity investments: ownership and voting rights. When you invest in stocks, you become a partial owner or shareholder of the company. This ownership grants you certain rights, including the ability to vote on certain corporate matters such as the election of board members and major corporate decisions. Capital appreciation. One of the primary benefits of investing in stocks is the potential for capital appreciation. As the value of the company increases, the price of its shares may rise, allowing investors to earn a profit when they sell their shares. Dividends. Many companies distribute a portion of their profits to shareholders in the form of dividends. Dividends represent a cash payment made on a per-share basis to shareholders. Not all stocks pay dividends, and dividend payments can vary in frequency and amount. Risk and volatility. Stocks are generally considered riskier investments compared to other asset classes such as bonds or cash. Stock prices can fluctuate significantly in response to various factors, including company performance, market conditions, economic indicators, and investor sentiment. This volatility introduces both opportunities for gain and the potential for loss. Market participation. Stocks provide investors with the opportunity to participate in the growth and success of companies across various industries and sectors. By investing in stocks, individuals can gain exposure to the overall stock market and benefit from the potential returns generated by a well-performing company. Liquidity. Stocks are generally highly liquid investments, meaning they can be bought or sold relatively easily on stock exchanges. This liquidity allows investors to convert their shares into cash quickly. Diversification options. The stock market offers a wide range of stocks across different sectors, sizes, and geographical locations. This provides investors with opportunities for diversification, allowing them to spread their investments across multiple companies to reduce risk. Market information. Stocks are extensively covered in financial news, and information about publicly traded companies is readily available. Investors can access company financial statements, analyst reports, and other sources of information to make informed investment decisions. Different types of stocks. Within the category of stocks, there are different types, including common stocks and preferred stocks. Common stocks represent the majority of publicly traded shares and offer voting rights and potential dividend payments. Preferred stocks have preferential rights over common stocks, such as a fixed dividend payment, but generally do not carry voting rights. It's important to note that investing in individual stocks carries specific risks related to the performance of the underlying company. Many investors choose to mitigate risk by diversifying their stock holdings through mutual funds, exchange-traded funds, ETFs, or other diversified investment vehicles. Before investing in stocks or equity investments, it's advisable to thoroughly research the companies and industries, assess your risk tolerance, and consider seeking guidance from a financial advisor or investment professional. Investing in individual stocks and stock funds, such as mutual funds or exchange-traded funds, are two different approaches to investing in the stock market. Here are some key points to consider when comparing the two. Investing in individual stocks, flexibility and control. Investing in individual stocks allows you to have direct ownership and control over the specific companies in which you invest. You can select stocks based on your own research, analysis, and investment criteria. Potential for higher returns. Picking individual stocks successfully can lead to higher returns compared to investing in stock funds. If you have the time, expertise, and research capabilities to identify undervalued stocks or companies with strong growth potential. Individual stock investments could potentially outperform the market. Higher risk and volatility. Investing in individual stocks carries higher risk and volatility compared to stock funds. The performance of an individual stock is directly tied to the success or failure of the underlying company. A single company's poor performance can have a significant impact on the value of your investment. Concentration risk. Investing in individual stocks can expose you to concentration risk if you hold a limited number of stocks. If one or a few of your stocks perform poorly, it can have a significant negative impact on your portfolio. Diversification is key to managing this risk. Investing in stock funds. Diversification. Stock funds pool investors' money to invest in a diversified portfolio of stocks across different companies, sectors, or regions. By investing in stock funds, you can achieve instant diversification, spreading your risk across a broader range of stocks. This helps to mitigate the impact of poor performance from individual stocks. Professional management. Stock funds are typically managed by professional fund managers who have expertise in selecting and managing stocks. They conduct research, perform analysis, and make investment decisions on behalf of the fund, aiming to achieve the fund's investment objectives. Lower transaction costs. Investing in individual stocks often involves transaction costs such as brokerage fees, whereas stock funds typically have lower transaction costs due to economies of scale. This can be advantageous for smaller investors or those who prefer a more cost-efficient approach. Passive versus active management. Stock funds can be categorized as either actively managed or passively managed. Actively managed funds aim to outperform the market by selecting stocks based on the fund manager's research and expertise. Passively managed funds, index funds, aim to replicate the performance of a specific stock market index, such as the S&P 500, and typically have lower expense ratios. Convenience and accessibility. Investing in stock funds provides convenience and accessibility since you can easily buy or sell shares through a brokerage account. It is a simpler way to gain exposure to a diversified portfolio of stocks without the need for extensive research and monitoring. Ultimately, the decision between investing in individual stocks or stock funds depends on your investment goals, risk tolerance, time commitment, and expertise. Some investors prefer the potential higher returns and greater control offered by individual stocks, while others opt for the diversification, professional management, and convenience provided by stock funds. Many investors also choose a combination of both approaches to balance their investment strategy. Consider your personal circumstances and consult with a financial advisor to determine the approach that aligns best with your goals and risk profile. Analyzing stock valuation, dividends, and growth potential is a fundamental part of assessing the investment potential of a stock. Here are key factors to consider when analyzing these aspects. Stock valuation. Stock valuation involves determining whether a stock is priced fairly or undervalued/overvalued based on its intrinsic value. Some common valuation methods include price to earnings (P/E) ratio. This ratio compares the stock's price to its earnings per share (EPS). A lower P/E ratio may suggest that the stock is undervalued, while a higher P/E ratio may indicate overvaluation. However, it's essential to compare the P/E ratio with industry peers and consider other factors to get a comprehensive view. Price to book (P/B) ratio. The P/B ratio compares a stock's price to its book value per share. A lower P/B ratio may indicate undervaluation, although it's crucial to consider industry norms and other factors. Dividend yield. Dividend yield measures the annual dividend payment relative to the stock's price. Comparing the dividend yield to the average yield in the industry or market can provide insights into whether the stock is attractively valued. Discounted cash flow (DCF) analysis. DCF analysis estimates the present value of a stock's future cash flows. It involves projecting future cash flows, applying a discount rate, and arriving at a fair value estimate. DCF analysis considers the time value of money and provides a comprehensive valuation approach. Dividends. Dividends represent a portion of a company's earnings that are distributed to shareholders. Key considerations regarding dividends include dividend history. Evaluate the company's track record of dividend payments, dividend growth, and consistency. Look for companies with a history of stable or increasing dividends, indicating a commitment to sharing profits with shareholders. Dividend payout ratio. The dividend payout ratio compares the dividends paid to the company's earnings. A sustainable dividend payout ratio indicates that the company can afford to continue paying dividends in the future. Dividend policy. Understand the company's dividend policy, including its approach to dividend payments, frequency, and potential for future increases or changes. Growth potential. Assessing a stock's growth potential involves considering various factors, including revenue and earnings growth. Analyze the company's historical revenue and earnings growth rates. Look for companies with consistent or accelerating growth, driven by factors such as expanding markets, innovative products/services, or successful market penetration. Industry and competitive analysis. Evaluate the industry's growth prospects, competitive landscape, and the company's position within it. Consider factors such as market share, competitive advantages, barriers to entry, and potential for disruption. Management and strategy. Assess the company's management team, their track record, and their strategic initiatives. Look for a clear vision, effective execution, and alignment with industry trends and opportunities. Innovation and R&D. Evaluate the company's focus on research and development, as well as its ability to innovate and adapt to changing market dynamics. This can be a crucial driver of long-term growth. Financial health. Consider the company's financial stability, including factors such as debt levels, cash flow generation, and profitability. A strong financial position enhances the company's ability to invest in growth opportunities. It's important to note that stock analysis involves both quantitative and qualitative factors. Analyzing financial statements, industry trends, news, and other relevant information can help form a comprehensive assessment of a stock's valuation, dividend prospects, and growth potential. Consider combining your own analysis with insights from reputable sources and consult with a financial advisor for personalized advice.